Bargains in sight, 3 dividend stocks you'll love, unless you hate money. Look, we get it. The market's been more jumpy than a squirrel on espresso. Inflation's playing peekaboo, the Fed's trying to be the cool parent while grounding everyone, and your favorite high-growth tech stocks are on a roller coaster straight to the bargain bin. But if you're smart, and you obviously are, because you're here, you're not panic selling. You're scanning the wreckage like a treasure hunter with a metal detector, looking for those gleaming dividend gems buried in the rubble. Welcome to the Dividend Investing Club, where we don't need triple-digit growth to sleep at night. We just want reliable income, long-term stability, and maybe a little capital appreciation to keep things spicy. And guess what? Some truly drool-worthy bargains are on sale right now, hiding in plain sight. Let's unwrap 3 dividend stocks that are so undervalued, they practically come with a bow on top. 1. Pfizer, PFE still coughing up dividends, not just cough syrup. Dividend yield, 6%. Forward PE, 11. Market cap, $150-ish. Dividend history, reliable, with a pulse stronger than most streaming services. Yes, that Pfizer. The company that went from big pharma villain to pandemic superhero and is now back to being, oddly cheap. Pfizer has had a rough post-COVID come-down, with everyone and their cousin dumping vaccine-related plays like they were NFTs of a crypto raccoon. But here's what the doom and gloomers are missing: Pfizer's not a one-trick pandemic pony. The company has a pipeline thicker than a Sunday newspaper, if you're old enough to remember those, including drugs targeting RSV, cancer, and migraines. Plus, its merger with Seagen gives it a biotech boost that's more than just a headline grabber, it's a revenue generator with oncology firepower. And that dividend? It's rock solid. Pfizer's payout ratio is conservative, even with all the post-COVID earnings drama. While growth might be sluggish in the short term, you're getting paid handsomely to wait. And if you're reinvesting dividends while shares are cheap? Even better. That's compounding magic, baby. 2. 3M, lawsuits, schmawsuits, it still sticks. Dividend yield, 6.3%. Forward PE, 10. Market cap, $50 billion and shrinking faster than your favorite jeans in the dryer. Dividend history, 65 consecutive years of increases. Hello, Dividend King. 3M is what happens when a company is both loved and loathed simultaneously. It's the duct tape of industrial stocks, not always pretty, but absurdly useful. And right now? 3M's valuation is flatter than a Kansas highway. Why? Legal baggage. Think earplug lawsuits, environmental claims, and investor fatigue. Fun times. But here's the thing, Wall Street's baked all the bad news into the price like it's making a doomsday casserole. Meanwhile, 3M is doing that little thing called business. It's spinning off its healthcare division to unlock value, trimming costs, and still generating free cash flow like a boss. That dividend? It's not just high, it's regal. 3M has been raising its payout since before your parents met. And while a cut might be on the table if things get really ugly, management has signaled they're committed to keeping that royalty check alive. Bottom line, if you believe lawsuits eventually settle, the fog clears, and boring, diversified industrials rise again, this might be your chance to scoop up a Dividend King on clearance. 3. Altria, sinfully profitable, morally questionable, financially delicious. Dividend yield, 9.2%. Forward PE, 8. Market cap, $74b. Dividend history, practically a religion. If there were a Mount Rushmore of dividend stocks, Altria would be chain-smoking at the top. Look, we're not here to moralize. If you're offended by tobacco profits, scroll on. But if you're intrigued by obscene cash flow, relentless shareholder returns, and a dividend yield that's higher than your uncle at Burning Man, welcome. Altria is the poster child for the slow death thesis. Every year, fewer people smoke. Every year, Altria shrugs and says, cool, we'll just raise prices. Rinse, repeat, profit. Their pricing power is absurd, their margins are luxurious, and their customers are, well, hooked. But wait, there's more, Altria's not sitting idle. They've made bets on smokeless products like ZYN, via their stake in Helix, vapes, and even dipped their toe in cannabis before deciding it wasn't quite baked enough yet. And let's not forget their big brother stake in Anheuser-Busch InBev. So yes, they're diversifying, albeit slowly, and with the deliberateness of a dad using MapQuest in 2005. The dividend? So juicy it's practically immoral. Over 9% yield with a manageable payout ratio for a cash-printing business. You don't get that often without taking serious risk, but with Altria, the risk is regulatory, not financial. What do these three have in common? Besides their uncomfortably high yields and being shunned by the trend-chasing crowd? They're cheap. They're all trading at laughably low PE ratios, offer consistent income, and have long histories of dividend reliability. These are companies that people love to hate, but quietly buy when no one's watching. Let's face it, the market today is obsessed with what's sexy: AI, EVs, crypto, space tourism. Meanwhile, the real wealth-building machines, boring, profitable, dividend-paying titans, are collecting dust in the bargain aisle. Perfect. That's exactly where savvy investors go shopping. A few words of caution, because we're not total degenerates. Are there risks? Obviously. Pfizer's pipeline could disappoint, 3 MS lawsuits could drag on forever, and Altria's regulators might finally decide it's time to actually outlaw fun. But guess what? That's why you're getting these juicy yields in the first place. If they were risk-free, they'd be T-bills. And T-bills don't buy lake houses or early retirements. Diversify. Reinvest. Stay calm. And if you pick your spots carefully, these dividend dynamos could be your ticket to compounding nirvana. Final thought, don't overthink it. Warren Buffett once said, the best chance to deploy capital is when things are going down. Well, he also owns big chunks of boring dividend names for a reason. If you've got cash, conviction, and a mildly rebellious streak that enjoys picking up what others are too nervous to touch, then congrats, you might just love these 3 dividend bargains more than your morning coffee. And hey, if you don't, at least they'll pay you to wait.